Did you know that the market makers have a limit to how far they can move price each day? If you don't understand this, you could be leaving money on the table. In this video, I'll show you how to use the ADR, or the average daily range, to predict market movements, avoid bad trades, and catch sniper entries using the BTMM strategy. So what is ADR and why is it important when trading the BTMM strategy? ADR stands for average daily range, and it measures how far a currency pair moves in a day. Now, market makers use ADR to control price movement, and understanding this can help you time your trades perfectly. So how does ADR work? Now, each currency pair has an average daily range. For instance, EUR/USD moves around 80 to 100 pips daily, while GBP/USD could move between 100 to 120 pips daily. Now listen to this. Market makers manipulate price within the ADR, meaning in between those two levels, to trap retail traders. Now, once the price reaches ADR, there is a high chance the market is going to reverse. There is a high chance the market will bounce back to where it came from. So if you ignore the ADR, you risk entering trades at the wrong time and getting caught up in the stop hands, something you definitely don't want. So how do you use ADR for sniper entries and exits? Now let's break down how to use ADR in your trading. Number one, you will use ADR to identify high probability trade zones. Each day, you will mark the ADR high and the ADR low at the start of each trading day. And then you will watch for price to approach these levels before executing your trades. Number two, you will use the ADR to spot the market maker stop hands and reversals. If price hits or exceeds the ADR, expect a fake breakout or a reversal. Look for BTMM confirmations like the TDI, the shark fins, the divergence, or EMA bounces and candlestick patterns and chart formations to confirm your trades. Number three, setting take profit and stop loss using the ADR. If prices have already moved 70 to 80% of its ADR, let's suppose you're trading EUR/USD and it has already moved 70 to 80% of its ADR, then be cautious with new entries. You don't want to be just taking trades anyhow. The market can bounce off against you, huge. You can also use the ADR to place stop losses just slightly outside the ADR low or the ADR high to avoid those market maker traps. So when combined with the BTMM indicators, ADR helps you avoid those bad trades and enter with confidence. Let's look at a live chart example, how ADR works in real trading. Now, for instance, here I have a pound-yen currency pair. We know that the general trend is bearish. We know that the general trend is bearish, right? And so we would expect the market to sell off around these areas. You can see when it came and tapped the ADR high, it is sold off all the way to the opposite side of the ADR. Okay, let's look at another asset. Let's look at CHFJPY. We can see the general trend is bearish. The market comes to the ADR high, taps it, and drops. Let's look at another one. This situation was repeated almost 5 times on Friday on all yen pairs. All yen pairs. So the general trend is bearish. You can see the market tap the ADR high and it drops the entire day. Let's look at another one. AUDCHF because I remember I had that trade. AUDCHF, here we are. So here we had a reversal, okay? We had a trade reversal because we were looking at this, our peak formation low. The market already had 3 days of rise and we had a very huge divergence. They hit the ADR high and they drop it the entire day. You can look at that. Look at that. So in other words, the ADR will help you get those high probability trade setups and also be trading in the safe zones where you expect that your trade will not get into drawdowns and your stop losses will not be hit anyhow. So using ADR correctly can help you trade like the market makers themselves and not against them. Sounds nice, right? So now that you understand how to use the ADR, the next step is learning how to combine it with other BTMM indicators for better sniper trades. Remember, you can just use one independent indicator and assume that you have everything right. All these indicators, you must combine them and understand them all together so that once you're taking the trade, all the indicators agree on that trade. In our next video, we will break down how to use the ADR and the EMAs and the TDI and the psychological levels. Remember, we have already done these videos. If you haven't watched the video about the EMAs or the psychological levels, kindly do so. In our next video, we'll be using or be looking at the TDI, and we also now get to look at how we use the ADR, the EMAs, the TDI, and the psychological levels to find those perfect trades. So make sure you don't miss it. Hit that subscribe button and turn on the notification bell right now. Just in case you haven't gotten my video about candlesticks and price action, there is a video I talked about how to master price action, and I shared a free book which you can download. I will leave the link to that book right below this video. So look for that link in the description below. Anyway, that's it for this video. Thank you so much for your time. I look forward to seeing you in the next one. Peace out.